Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo. Welcome to Friday. I hope you're all having an amazing week. I am here with your mortgage rate update. We've got an interesting idea to explore. I'm excited to share this, and also this is going to be a feedback session. I'm going to really encourage you guys to reach out and let me know what some of your thoughts are. And then for our Did You Know section, we're going to take a break from appraisals this week. We're going to talk about something else. So let's get right into it. As we always do, we're going to kick things off with the average mortgage rates as of recording this podcast the Thursday before its release. And this is also according to Mortgage News Daily's survey of mortgage rates. 30-year fixed-rate mortgage is currently averaging 7.01%, slightly down from 7.13% last week. The 15-year fixed-rate mortgage is averaging 6.37%, slightly down from 6.55% last week. The 30-year jumbo fixed-rate mortgage is averaging 7.2%, just a touch down from 7.25% last week. And the 30-year FHA mortgage saw the best improvement. Those are averaging now 6.32% compared to 6.62% last week. And the 7.6 SOFR adjustable rate mortgage is averaging 6.95%, down just a touch from 7%. The bond market, as we always take a look at right after we look at those mortgage rates, is going to show us possibly where interest rates are going to go maybe in the short term here. So we saw the interest rates go down. Bond yields, though, as of recording this episode, have gone up a little bit. Here's the bond yields by the numbers. The 10-year U.S. Treasury yield is currently averaging 4.422%. That's up from 4.347%. That's important. The closer we get to 4.5, which is what we're calling the resistance level, that's where if we see it go up above that number, it could stay up, and that will translate to a higher cost lending environment, higher interest rates. The 5-year U.S. Treasury yield is at right now 4.285%, up slightly from 4.195%, and the 2-year Treasury yield is at 4.267%, and that's up from the 4.226% it was last week. Let's dive in. Since last week, we talked about a bunch of things that contributed to the rate environment that we discussed last week. We saw some interest rate improvement. It's proving to go in the opposite direction for bonds. I'll start off with the blockbuster reason: government spending. The monthly U.S. federal budget is in a deficit now, as of the reading that was published today, as of recording this episode, in the shortfall of $257 billion. That is compared to what was being expected of $243 billion shortfall, and that compared to last month's $67 billion shortfall. It's a pretty big and stark increase. This is going to translate to higher interest rates because, think about it this way, government has a deficit, debt. They need to service the debt. They sell more bonds. The bonds are then put out to auction. The more you have at auction, high supply, demand is remaining not consistent. And the reason being is that the stock market's doing really well. So there's not a lot of reason right now, as the stock market's doing very well, for investors to put their money into these safe haven assets, as we've talked about in the past. So with lower demand and higher supply, you get lower price. And the lower the price, the higher the yield. The higher the yield, the higher we see interest rates go. Other things of note, a little bit of a shiny spot now after looking at that trade deficit, or rather the U.S. budget deficit. The consumer credit actually was not growing to the level that was expected. So the reading that we received today was $6 billion was the growth for U.S. consumer credit. That was projected to be $13 billion. This means that Americans are not charging their cards as much, and maybe there's some softening in the retail sales, which that's a figure, and that's data that we're going to get next week, so I'll be happy to report out on that. Also, consumer sentiment is doing pretty well. The reading that we have from this past week was 73, so it's shown some improvement, but it's staying stable. The last consumer sentiment reading we got was at 73 as well. We also received one of our inflation gauges this week, the Consumer Price Index. Though this is not the Fed's preferred inflation gauge, it is still an inflation gauge worth looking at. And that CPI came in at a monthly increase of 0.2%. And that was exactly at expectation. And the year over year was at 2.6%, exactly at expectation. And for both of those numbers, exactly in line with the reading from the prior month. So it did tick up a little bit, if you recall, from last month when we reported out on it, but now it's kind of leveling out. Maybe the next move could be down. That's what we're going to want to see if we want to see the Fed continue with cutting interest rates when they meet at their next meeting, which is in December. The core CPI, much of the same. Increase of 0.3% month over month. Year over year, core CPI running at 3.3% growth year over year. Again, moderate cost increases. The one that we're going to look at now is the Producer Price Index. This is the first stop, and then the costs there get translated to the consumer, and that saw quite a bit of a jump. It rose 0.2% month over month. And the annual PPI, the Producer Price Index, is up to 2.4%. So moderate producer cost increases there could translate to some higher costs, which means inflation could tick up a little bit, maybe at the next reading that we get next month. We'll see. Stay tuned. Also, jobless claims continue to undercut what the expectations are. The jobless claims reading from this week came in at 217,000. That was below the 220,000 that was expected, and also below the prior reading. So there is still a lot of resiliency in the labor market. Overall, the government spending paired with this sticky inflation, the market is still counting on a rate cut in December, but I'm of the opinion that it doesn't necessarily need to happen, especially if we continue to get data that supports a status quo with no meaningful improvement on inflation, no weakening in the job market. But we got a unanimous vote when the Fed cut the rate earlier this month. So everyone's online with cutting these interest rates. We'll see, but as you can tell, as we've been looking at these interest rates together week over week, since the rate cut, not much has happened. We saw it go up a little bit and then it goes down. We've talked about that in the past, and that's kind of the trend of history. If there's a rate cut, rates do go up a little bit and then they start to settle back down. The 0.5 point cut that happened before in September, though, that was a little bit of an anomaly because rates just went up and then they kept going up. And this was the first time that we actually saw some relief since the Fed cut the interest rates. Sounds counterintuitive. But the other thing that's important to note that's actually affecting these mortgage rates right now is the fact that the mortgage rate market is driven by what's called the secondary market. So we'll just take it to school real quick. The space that I occupy professionally is as a mortgage loan originator and branch manager. I assist families purchasing homes and I provide them with the financing through guaranteed rate. Now, you're buying a home, let's say. I work on your loan file. I assist you every step of the way. Your loan closes. You get the funding from rate. We provide the funding. And then we will either service that loan, which means we'll collect those payments, or the servicing goes to the investor or gets sold off to the investor, and then there's an investor that's servicing your loan. Now that investor wants to keep lending money to continue making money. What happens with your mortgage is it gets pooled together in what's called a mortgage-backed security pool, which becomes a financial instrument that people can invest in. Think of it like we talked about the bond market. It gets pooled together with mortgages that are comparable to your loan and your qualification. And then investors will invest in that in what we call the secondary market. That's how money flows into the system. Some money comes from the Fed, some money comes from Fannie Mae, Freddie Mac, but where it really originates and is in this secondary market. And as people are investing there, we have this dissonance yet again. We talk about this very often, and that creates a lot of this volatility. The dissonance that's occurring is everyone's chomping at the bit for lower interest rates, We're not seeing them transpire. We're not feeling it. Looking down the line and looking at the way things are in the fundamentals of the market and the real estate world and actually in the financial markets, there's not a lot of evidence to support that there will be meaningful decreases in lending costs. But it doesn't change the mentality of the investor. And they see, oh, well, let's say they have these mortgages and they all have 7% interest rates, right? Well, they know as soon as interest rates go down, those loans are getting refinanced and then they are not making money on that anymore. So because the nature is, at least the mentality is, this is going to be a short-term investment, they're going to try and get the most out of it right now. How do they get the most out of it? They bid low. When they bid low, the yield goes higher, and that's why we see these interest rates in the level that they currently are. I'm setting the stage for the idea that I want to explore with you, and I also would love to get your feedback on. So last week we talked about kind of controversial idea I had, which was, what if interest rates just don't go down? This is where interest rates are now. And I had some great comments on social media, and I really appreciated the engaging discussions that occurred in my direct messages and on the comments. And to that end, I want to kind of push it a little further. Let's steelman this. Let's say interest rates stay elevated. We see the Fed, let's say they even cut rates, but rates don't go down, right? We still continue to see government spending ripping high, and that's going to create a higher rate environment. And that's something that also stresses the Fed and stresses the U.S. government. So inflation being sticky, everything being what it is, and let's say we have interest rates that stay high, is it possible that exposure to this market environment for a longer period of time could possibly create an environment where the buyers, even though there's a ton of demand that's pent up, the buyers aren't actively looking, and then now the buyer pool starts cooling? Now, the only thing that I have to say to that where I can make a counter argument against it is the demand in high desirable areas is still absolutely insane. You're not getting anything under list price. If things are listed appropriately at the right price point, it's a bidding war, no matter where you go and no matter what the state of the property is. For the most part, it's competitive. It's crazy competitive. So if we're looking at it that way, rate environment stays high. People now are starting to see we got through another round of holidays. So now we're going into the beginning of the new year. People were still paying. Last month, I was listening to a podcast that's part of my daily routine and daily rotation. They were talking about how there was a percentage of the American consumer that's still paying off their holiday spending, which is bonkers. But still a lot of consumers paying off their holiday spending from last year. Now that we saw just now, consumer credit didn't increase as much as what was expected, almost half of what the expectation was. So people aren't spending a lot of money. They're not charging their cards. Now, what I'm reading that as is a little bit more of a conservative approach by the American consumer, albeit we're through the election. But now that's not like, oh, it's behind us and we move along. The election's in our rearview mirror, but until we actually have the inauguration, it's going to be nonstop news media coverage about every little thing that's going to be happening. And, for good reason, these are decisions that are being made by a new administration that's going to wind up informing what the state of the economy is going to look like, because these types of things will affect what the monetary policy of the Fed's going to look like. It will affect investor sentiment in the stock market and in the bond market. So I'm not saying that it's not important, but everything that happens will wind up swinging things one way or the other. And with all of that creates volatility. So let's say now we go into next year, people are really tight. Let's say credit scores start going down overall, right? On average for the American consumer. People are going to be less inclined to buy. Now, what if the people who may be ready to buy now before the holidays, they go through the holidays and they're like, we got to rein in our spending. We got to actually pay off some of this debt before we incur more debt. There could be an argument, I think. There could be an argument there that buyers will start to actually take more of a seat and just hope for lower interest rates, deal with their living situations as they stand. It's still very much in New Jersey, at least in the New York metro area, a seller's need market. And what I mean by that is debt, death, divorce. Those are the three things that are driving the listings for the most part. If it's outside of that, it's very rare. Or it's someone who's moving to another market. We talked at, I think, last episode, South Carolina and Florida, still a ton of inventory that's available, but you're shouldering the cost of what's going to look like a very high insurance premium because those areas, particularly the southeast of the U.S., still reeling and still putting the pieces back together after a double whammy of two hurricanes that came through in Milton and Helene. So with that going on, it's still disrupting normal due course of market down there. But people are able to get deals and they may suffer those higher costs. And maybe they're not going to the southeast. Maybe people are leaving the New York metro area to go to another area because by the numbers, that makes probably the most sense financially. Lower property values in the less desirable, less trafficked areas. Not to say that other places like the Midwest are not desirable, but there is more inventory than there is, and there's less competition than there is here in the Northeast in particular. So I'm saying that there could be a very good case to be made that if buyers start to cool off, if we see this rate environment for a year and we continue to have this volatility, people are going to tap out. I've seen it. I've been helping people for quite a while now navigate this market for the couple years that it's been so wild. And there's buyer fatigue sets in. And you're like, you know what? We're going to renew the lease for a year. We'll touch base. And normally I like to follow up and check in to see how everyone's doing. But that's the way the situation is right now. So I think there could be a case to be made, but I would love to hear your thoughts and your feedback. So please, I always encourage you at the end of every show to send me an email, but please do. My email address is in the description of the show on whatever podcast platform you're listening to or on YouTube. Reach out to me. Let me know what you think. I'll also be posting on social, so follow me on social. We can engage there. I would love to get your feedback. Now, we were talking about consumer spending and the holidays. So our Did You Know section today is going to be about credit scores, and I am going to debunk. I'm ready. I'm ready to debunk the myth. By raise of hands, how many people here have heard someone say, oh, carry a small balance on your credit card, and you're going to see your credit scores increase? Wrong. So this has been debunked. If you have a balance on your credit card versus no balance on your credit card, and you pay it off, 100% paid off every month, you will have a better credit score than someone carrying a balance. Now, that being said, that is due to one major change that happened in the assessment of someone's credit profile, and this goes back quite a few years. Something that was introduced a few years ago was called trended credit. And what trended credit means, when they're giving and deriving the scores for your credit profile, which there are 3 bureaus that are relied upon, Equifax, TransUnion, and I am blanking right now. Equifax, TransUnion, and Experian. There it is. We got there together. So Equifax, TransUnion, and Experian, and they all look at your credit profile differently, and that's why you have 3 different scores. They weight things differently, but through all of them, they implemented this trended credit, which instead of just looking at what your current balances are compared to what your limits are, balance to limit ratio, they are looking at, well, how long did you carry a balance on that card for? Oh, and then it was paid off? Well, that's going to boost your scores, but then the longer the period of time goes on with keeping that balance low, then you're going to see even more of an increase in your credit scores. And I just mentioned balance to limit ratios. I like to explain that. Let's say you have a credit card that has a limit of $1,000 and you charge $500 on it in a month. You have a 50% balance to limit ratio. I will say from my experience, you're towing the line. That could be negatively impacting your scores because of that 50% utilization. Now, if you were to have $300 on that card and you're limit is $1,000, 30%, you're going to see a better credit score than if you carried that 50% balance to limit ratio. The best, if you're going to have a balance, if you can't pay it off 100%, the best thing you can do is pay it down 10% or less. That's your sweet spot. That's the best it's going to be, short of paying it off in full. My last piece of advice for you is when you are applying for credit, and let's say you bought your new home, you're going to Home Depot to get all the things that you need. Maybe it's furniture, maybe it's tools, whatever it may be. And they always ask you if you'd like to open a Home Depot credit card. And you would like to because you want to take advantage of a 12% or 12-month 0% interest when you open the new card promo thing, which is awesome. So you say yes. And they give them the information. And then they say, oh, we have you approved for $5,000. Meanwhile, your card's got $2,000 worth of stuff in it. You're like, oh, great. I don't need that. I'll just take the $2,000. No, do not do that. The reason why you don't do that is what we just talked about. That credit utilization, the balance to limit ratio. If they are affording you the $5,000, take the $5,000. This way, your balance to limit ratio will start out under 50%. Otherwise, if you initiate that credit line with $2,000 to match the amount that you're purchasing, you now have a card on your credit report that's maxed out. Even though it's 0% interest and you're going to be paying it down in that 12-month period, you're maxed out, and that's going to negatively impact your scores on top of the negative impact of having a credit inquiry. So that's our Did You Know section today. And that's it for the show. I hope you found this helpful and useful. If you have any questions, comments, anything you'd like me to explore, and again, please, I would love your feedback. Would love to engage in some conversation and maybe bring up some other points that you would like made on next week's show. I do believe that we will have our existing home sales data. It's my favorite time of the month. So I will be reporting out on the National Association of Realtors' existing home sales data after our brief review of where mortgage rates are at that time. But in the meantime, I hope you all have a wonderful weekend. Take good care.